But what I do is I try to educate on some of these strategies that the wealthy do to help people get to that next level, to help them improve their financial lives, to help them accomplish their goals and maybe do it in a more efficient or effective way. Welcome to another edition of Wealthy and Wise Wednesdays, my weekly podcast where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, September 15th. I'm Ron Sneller, registered financial consultant and investment advisor representative. Thanks for joining me on this week's podcast. So today we're going to be talking about exploring your investment options and building wealth through what I like to call ownership investments. Now, before we do that, I had a really interesting week so far. Over the weekend, I posted a video on TikTok. I am a new TikTok user, but I posted a video that exploded and went viral. And as I record this, it's Wednesday, September 15th. I now have over 100,000 followers, probably on the way to 150,000 followers. So any of my TikTok people watching this, thank you. I appreciate it. Just can't believe how fast I went viral and blew up on TikTok. So a lot of people finding the content very interesting for financial education and increasing their financial literacy. So this video will be posted to YouTube. So if you like financial education, do me a favor, follow this channel at Sneller Financial on YouTube and share this content out there to help other people increase their financial literacy and help them improve their financial lives. Now, the one main video on TikTok that went viral, I just did a brief 3-minute video just with some educational principles about how the wealthy over time build up assets so they can get to a point where they start, or I should say, when they stop trading their time for money and they can start leveraging the assets in which they had built. I talked about leveraging debt. And when I talked about that, I was specifically speaking about real estate, borrowing against the value of their real estate, being able to use that money for themselves, completely tax-free because debt is not taxable. And then whether it's single family homes or apartment buildings or larger office buildings, they're not actually paying the debt back because their tenants are doing it. Or I should say their tenants are doing it for them through their rent payments. So that can be a really good wealth building strategy. And I said that one key to all of this, something that acts in the same way, is cash value life insurance. That's why the wealthy sock away hundreds of thousands, if not millions of dollars every year into these plans because they work the same way. These plans are funded with after-tax dollars. They grow tax-free. They can be accessed tax-free. They can be turned into a tax-free retirement income. And then there's the death benefit that passes on to their family and their heirs tax-free. And as that asset is growing, now it is a long-term savings program, but as that asset is growing, you can borrow against the value of the asset to acquire other investments or to finance personal purchases. And because you're borrowing against the value, there's no income tax due. But because you're not withdrawing from the life insurance account, remember, a life insurance company is giving you a loan out of their resources. They're simply using your policy or your policy values as collateral. The money's not coming out. So your money continues to grow and compound and snowball, even though a good portion of your money is actually working elsewhere to acquire real estate or invest in your business or whatever the case might be. So again, the wealthy know how to use leverage. They know how to have their money working for them in two places at once. So that's the video that blew up. A lot of people were interested in the cash value life insurance and how to do this. But the thing is, cash value life insurance in and of itself is not going to make you wealthy. It will prevent you from becoming poor. It's a hedge. It is insurance. It's a hedge against risk. It's a hedge against market volatility. It helps to reduce your future income taxes, and it helps to improve your liquidity position. But in and of itself, it's not going to make you wealthy. How it can help make you wealthy is having guaranteed access to that cash very, very quickly in order to invest in real estate, in order to invest in the stock market, in order to expand your business, in order to capitalize on opportunities that present themselves. Because the bottom line is, most people, most average, everyday American people, lock up all of their money in a qualified, government-sponsored pre-tax retirement plan. And so most people have very little liquidity and no access to money to take advantage of opportunity. So cash value life insurance, what it can do is it can provide safety, liquidity, and guaranteed access to capital to help you make your investments. So that's now what I want to start talking about on the second part of this podcast or this talk here today, is building wealth through acquiring ownership assets. Okay. Ownership investments. Now, what is an ownership investment? Well, an ownership investment is where you own shares of a company or you own an asset that can appreciate in value, that you can sell later for profit, or you own an asset that can kick off cash flow, or do both. Okay. And it's really interesting to see how the wealthiest people in this world have created their wealth. 9 times out of 10, they have done so through starting their own company, which has grown and expanded and exploded. Okay. Or sometimes they might be able to buy into a company, or it's a partnership. Or maybe they buy it and they rehab it and they get it profitable again. But that's how the majority of the wealthy become wealthy. It's through ownership of a company that brings in tremendous amounts of cash flow. Now, for the average everyday person watching this, starting a business like that turns into a large business, it might not be practical for you. However, that doesn't mean that you can't own a company. And most people say, well, how is that possible? The bottom line is that most people do not invest in the stock market. And the stock market is a very easy, convenient, and relatively quick way where you can start buying ownership shares in different companies. For example, I talk with a lot of people every day in all walks of life, and I'll often see them decked out in head to toe with, let's say, Nike. Okay. And we get to chatting. And of course, since I'm a financial person, I eventually turn the conversation around and I ask them, obviously you're pretty enthusiastic about Nike, right? Oh yeah. They'll rant and rave about the product and the brand and how much they love it. And so I'll ask them, okay, so have you ever told any family members or friends about it? Kind of share this enthusiasm with you and or shared your enthusiasm with them and maybe influence their decision to make purchases of Nike, of their products or of their services. Oh yeah, absolutely. I tell people about it all the time. Okay, well, how is Nike compensating you for doing that? I mean, you're spending your time and your effort to spread the word and to help increase sales. And then they just get a blank stare, deer in the headlights. And I kind of have to then tell them, you understand, by investing in the company stock, you will be able to participate in the growth, in the gains, and in the profitability of this company. Now, AKA, as an aside, I should just kind of stop right here and say that this is not personalized advice. That's not a recommendation to buy or sell Nike. I'm just using that as an example. Okay. But most people, they don't invest in the stock market, or even if they do, it's very passive. It's through their 401k. They don't actually know what they own and what it may be able to do for them in the future. And the other thing is, I guess I should say also with Nike, I mean, companies will have to report their quarterly earnings. And just because Nike may show a profit one quarter, it doesn't necessarily mean that it will reflect in the stock price and that the stock price will go up. I mean, those things can move and it can be driven by a lot of different things from consumer sentiment to emotions and all sorts of things. So just because Nike's profitable one quarter doesn't guarantee that the stock is going to go up. However, if you are a long-term investor and you find a way to invest in solid companies and solid funds over time, you should be able to do very, very well in the market and grow your wealth. Now, you probably have heard about the need to diversify, that you don't want to invest in just one company like Nike, and that you really want to have a broad-based portfolio investing in a variety of companies and in a variety of sectors. Now, that's where things start to get a little bit confusing. So you probably have heard of being able to invest in mutual funds and index funds and ETFs, because a mutual fund is a basket of stocks where there's already some diversification within that mutual fund for you. Okay. And, when at our investment firm, when we're talking about managing client investments, we have an entire investment portfolio where we have all sorts of strategies and these different funds that will include all of these sectors, because you do want to be diversified. Number one, you don't want to have all your eggs in one basket just in case that company ends up tanking, in case there ends up being corruption and it hurts them and they end up going bankrupt and they lose all your money, right? Now granted, that's like a worst case kind of outlandish scenario, but it's happened, right? But even if the fundamentals start going south and the company lose money and the value of the stock drops dramatically, you don't want to have all of your money there. Okay. So you do want to be diversified. But you also, part of diversification is about having exposure to a variety of sectors, to a variety of market sectors, just in case one of these sectors, it gets really hot. You want to have some exposure there. You don't want to miss out completely on that. So it may be you want to have some exposure to foreign stocks, some of these international equities, whether it's developed markets or whether it's emerging markets. Okay. You may want to have some exposure to mid-cap stocks, which are middle-sized companies. You may want to have some exposure to small-cap stocks, those stocks that are a little bit more of a risk, but have a little bit more upside potential, generally speaking, because they have a lot larger room to grow. You may want to have exposure to the real estate market. And look, I'm a huge fan, although I do not get compensated on physical real estate. I can't sell it to you. I'm not a licensed agent. I educate on the process of using mortgage as debt in order to invest or to do different things. I don't do mortgages anymore. I gave up that license to focus on financial planning. So I'll educate on these different topics that I don't necessarily get compensated for. Again, it's not financial advice. It's just education. But what I'm saying is, if you want to own real estate, perhaps owning physical real estate is not practical for you, but you can still invest in the real estate market and be exposed to the real estate sector by owning real estate investment trusts as part of your portfolio. Again, that's not a personalized recommendation. It's an idea of things that you could do. You may be a fan of precious metals, but maybe buying a bunch of physical precious metal and storing it somewhere, maybe that is not practical for you. So through our investment platform, we can buy paper shares of the metal in the form of ETFs, and we can get you invested in gold mining companies, for example. There's a lot of different things that we can do to be diversified, both to reduce risk, but also to have exposure to a variety of different market sectors. Again, why you want to have exposure to different market sectors is this, for example. In the year 2020, last year, technology was the big sector that outperformed all others. That was the big winner. This year, and I am filming this or recording this in the middle of September 2021, for most of this year, energy was the hot market sector. But during the summer, energy kind of cooled off a little bit, and the financial sector took over, and the financial sector was the top performing sector there for the last 1 or 2 months. But just recently, the financials cooled off a little bit, and you know what overtook it? Real estate. So having these paper shares of real estate, like paper shares of real estate through a real estate investment trust, having some exposure to that in your portfolio would, at least at this point, have made you very, very happy this year. And so generally speaking, what we want is a well-diversified portfolio with balance where you have exposure to all of those different market sectors. But again, every single investment strategy that we put into place is personalized based on the individual specific goals, their resources, their risk tolerance, but also their time horizon. So a lot of people have begun to kind of understand that in order to build their wealth, and for most average everyday people, when they think of wealth, they're not necessarily trying to get wealthy, right? They're trying to do what typical people do, which is for the most part, save for retirement so they can have a comfortable retirement and not have to worry about money. But what I do is I try to educate on some of these strategies that the wealthy do to help people get to that next level, to help them improve their financial lives, to help them accomplish their goals and maybe do it in a more efficient or effective way. But people have begun to realize that in order to build this wealth, in order to stay ahead of the pace of inflation, because if you stick your money in the bank, you're actually losing value by not keeping up with the pace of inflation. So people have begun to understand this, but it's still confusing. A lot of people, it bores them to death. A lot of people are intimidated by it. They don't like it. And so a lot of people stuff all of their money in their 401k, knowing that, hey, I'm invested in something, but without really understanding that their 401k is, for the most part, locked up until they're 59 and a half years old at the minimum. And that in retirement, every penny they draw from 401k is reportable taxable income. So in addition to just investment management, we're also kind of looking at tax strategies as well. How much should go in the 401k? Maybe how much should we put into a Roth 401k or a Roth IRA? Let's diversify our risk and improve our liquidity position and diversify future taxes with cash value life insurance. That'll also help us to then invest in a brokerage account, which is an account that we can manage for you, because knowing what your income in retirement is likely to be lets us know, at least under current tax law, how much capital gains we can pull from a brokerage account without those capital gains being taxable. And then if we do that right, we can also set it up to where your Social Security benefits are not taxable. So there's a lot that goes into maximizing wealth. It's not all about chasing rates of return and trying to build up a huge net worth in your 401k, because that's just on paper. That's not taking into consideration any market volatility when you go to draw out of your 401k. That's not taking into consideration the fact that that money hasn't been taxed yet, and it will be taxed when you pull it out. And I think it will be at much higher tax rates than what you took the deduction on here today, just because of the country being 30 trillion in debt, Social Security being broke, Medicare being insolvent. Again, that is my opinion, but that's the way that I do planning, is balance both from a risk tolerance standpoint and from a taxation standpoint. So if these things are beginning to intrigue you and you want to save, you want to invest, you want to build wealth through acquiring ownership assets, whether that is stocks in a company, whether that is stocks or even physical ownership in real estate, precious metals, things of that nature, I can help you. I can help you get to that next level, again, by personalizing a plan based on your specific goals, your needs, your resources, your time horizon, your risk tolerance, and help build that out for you. So if you are interested in these topics of improving your financial IQ and setting yourself up for growing wealth and not having to worry about money, reach out to me. Again, follow me on YouTube, share this content out there. You can reach me at snellerfinancial.com. That's my website. At ronald.sneller@snellerfinancial.com is my email. And also my TikTok page has gotten pretty popular. And I'm also on LinkedIn and Instagram as well. So I'm either under Sneller Financial or just by my name, Ron Sneller. Okay. So I hope to hear from you guys. And again, feel free, if you enjoyed this talk, share your thoughts below. Feel free to comment on this. But that's all that we have time for today. So I really, really hope that this helped. So anyway, let's wrap up. That's my rant. And as always, thanks for listening.